Hi, everyone. This is Lauren Nieves from Aster Realty Capital. We have Joe joining us any second. He just did the registration.
Sorry about the last minute link change.
Oh, no problem. No problem. I know it happens.
Welcome, everybody, to the Alternative Investing Club. We'll get started in just a few minutes. I see that Joe's connecting right now.
Beautiful. Daniel, I will be sharing my screen to support Joe. So just so you know.
Okay. I remember, Joe, you were here a couple of months ago. Has it been a year or
Probably
more?
more than a couple of months. Yeah, probably more than a couple of months. How are you, Daniel? Good to see you.
I'm doing well. Good to see you. Let me see here. I can find out exactly when you were here in just a moment.
I think it was probably about 13, 14 months ago.
Yeah, time flies when you're having a
Yeah,
podcast.
December 1st, 2023.
Wow.
December
That's
1st,
been a little bit.
2020. Yeah,
I remember you gave a good talk too, so I'm looking forward to this one.
wonderful. So am I. Um,
We've had a few changes since then. I think at that point, I guess we were outside of Intel at that point. So we've been a public club. We've been operating open to the public for a little over a year and a half.
mhm.
And we still have quite a number of the core people that are still here from Intel. So it's
That's
been a good
it's
group.
pretty fantastic. That's
Yeah,
pretty fantastic.
it's been a good group.
Um, I've
We get a lot of great speakers, and so I'm glad I can bring them to this group.
I'm very happy to join again. Let me know, Laura, when maybe what I'll give you like a little bit of an intro. We've done once a month. We're doing our to our investors. It's something that we call Glassdoor. Really, the concept is we want to create as much transparency as possible with our investors and potential investors to explain to them how we look at the market, what it is that keeps us busy, how we do our asset management, how do we underwrite a deal specifically in a market that is, sort of like somewhat volatile. We don't know where things are heading. There's a lot of insecurity out there. And so we're essentially created this one-to-one conversation where we simply share what we feel internally and about the market and how our projects are doing and things of that nature. Alongside that, we also look at sort of like the major components that makes the market and how we makes our decisions and really what drives our decisions. And with your permission, I'd love to maybe share that. It's a nice little presentation that's easy to follow, which I will talk through and sort of like take everyone here through our analysis and thinking and how is it based on market fundamentals. If that sounds okay, Daniel.
That sounds great. I know
Awesome.
I usually confer on the topic of the talk ahead of time, and in this case we didn't, and so I just entitled the topic of this talk Aster Realty Capital. Let me give a couple of initial announcements, and then I'll let you
Sure,
kick off.
of course.
So the first announcement is, of course, the Alternative Investing Club Fund. The club fund is now open, and we'll be making our first investment into DLP Capital in approximately 2 weeks. So if you're interested in being part of the club fund, and if you're interested in DLP Capital or the manufactured housing group that we brought in 2 weeks ago, please contact me and get your funding in the next 2 weeks. After that, we will have some other club fund speakers, and there'll be other opportunities to put money into the fund. But we're going to kind of block off this particular opportunity and put our first tranche of money in 2 weeks. So if you're interested,
Daniel, you did just mute yourself, by the way.
did you hear any of what I just said?
The last 10 seconds we didn't hear.
Oh, okay, good. Okay. So I just said the next item is I have begun podcasting again. And so my goal is to we're kind of spinning it up since it's just getting started. I did 100 episodes of a podcast in 2020 and I loved it. It was a great way to network with people. It was a great way of meeting people. It's a great way of kind of finding great speakers. What I ended up doing is I took really the best of the podcast and I invited them to be speakers here at this particular group with the live audience. And so we're gonna start that again, and it's gonna be a way to find new investments that are in the market and just to provide general education to everybody in the club. The first video is up on YouTube. If you look for Alternative Investing Club, I could show you that right here actually. And it is a little rough. It's unedited and directly put in from the Zoom call. We're also publishing shorts now from our various talks on the channel as well. So here's our, where is it, live? Here's our first podcast. The podcast is called Revolutions of Returns, or ROR. And if you have the chance, we're going to be recording it every day at either 9 or 10 a.m. And the last announcement is that I'm almost at a point with the new club webpage where I'm going to be able to start inviting a couple of beta testers onto the page. And of course, I just shut down my development server here, but let me launch it again. But anyway, the club site is going to be live fairly soon, and it's going to be a big upgrade. It's going to be nice. Each individual meeting is going to have its own landing page. Each speaker is going to have their own landing page. We're going to have categories. It's going to be sortable. And it's going to bring in articles as well as published courses and also information about the fund, of course, as well. And then it's scheduled for the next round of upgrades, but a community forums will be there as well. So with all of those, I would like to turn it over to Joe. Joe, welcome to the Alternative Investing Club. We're glad you are here. Let us know what your update is.
Wonderful. Good to be here, Daniel, and thank you all for joining us. Today, I'm going to be sharing with you, as I said earlier, sort of like a peek as to our operation, Aster Realty Capital, from the standpoints of how we make decisions. And during that discussions, we're going to look at fundamentals, which obviously helps us make determinations of where we should invest or maybe hold on investing, and how we sort of like run the process. And during, we're going to be talking about articles and statistics and bring all that good stuff together. Anybody has a question, feel free. You got the message board on the right. Periodically, I'll check up on it. Otherwise, raise a hand, interact. I'm looking to have as much interaction as possible as we go through this. If it's going to sound peachy, I hope not. I apologize in advance. That is certainly not my intention. My intention is to share with you how we do what we do. And so with that in mind, Laura, please put the presentation up. And I don't know if I can have the control over it. Let me see that I have it. Okay, let me see. Click start. Oh yeah, okay, great, very great. So we have control. All right. So Glassdoor obviously makes good sense. We want to take a closer look, not just at the deals that we do, but we also do a lot of asset management, which means we pay attention to how deals are progressing. A little bit by way of introduction, my name is Joe Burco. I'm the CEO of a company called Aster Realty Capital, Aster Realty Capital, a firm I started sometime around 8 years, predicated on 21 years of real estate advisory, real estate investments, and leading investors, real estate investment sales, and so on. So you might say that I'm in the market for 29 and a half, call it 30 years, since 1995. That's when I started out of New York City, a super competitive market where, you sort of like, if you ever saw New Yorkers walk, they're always like on a mission to go somewhere, regardless if they're going to grab a cup of coffee. They're always on a mission to do something. It's a highly fast market, very, very competitive market. And that's where I really cut my teeth. And I think that one of the things I'm super proud of, after doing it close to 30 years, or at the time, 20 some odd years before I started Aster, is that we always maintain, and I always maintain, a very good name and a good reputation. You know, it's a dog-eat-dog world out there, and so it's very easy to take shortcuts and stuff like that. We've never done that, and I'm very proud of the fact that we were always highly conscious and very concerned, making sure that we always have a good name and reputation. And so about sometime around 2014, after many years of investment myself, I decided that after, well, you know, after that, how many years, I feel comfortable to start leading investments and start allowing people that I know, friends, family, and else and others to come and join me in investments in real estate projects. And so to date, we have we're participating in 12 top US performing markets, markets that are growing, both with employment, positive migration, but not just positive migration, the kind of positive migration that brings and yields more industry and more innovation and more of that. So a certain type of like an age group that I particularly look for when I look at growth and so on. So really, we are at the top 12 performing markets. You know, overall, our participation in real estate spans across $2.7 billion in stabilized value. We do something called mark to market, which we'll talk about it on a quarterly basis to understand the valuation. Is the values of the assets are up? Are they down? Are they the same? And so as of today, our overall participation lies at around 2.7, with $120 million of capital raised from inception and around 23.6% average return, and over 3,000 units, luxury units in major markets, and call it 4.1 million square feet of real estate. So that's sort of like, you know, the numerical side of our story. The collective of 65 years is the 30 years of myself and other executives within our office. You might say that we have a collective experience in real estate that amasses 65 years. These are generally the areas that we invest with. Some areas were exited, and I probably will not quickly return. The tax burdens that certain states or certain city have that I particularly find cumbersome and that sort of like reduce the returns that we'd like to see in certain areas. One of them is Chicago. You know, Chicago is a very heavy tax. There's a lot of heavy taxes in New York, but we're very active over there and other locations as well. But you can pretty much get the idea. I'll share with you now something else, which we're not going to spend much time on, but this is our portfolio from inception. Okay, as you can see, each and every project that we have is over here. Anything below the line is actually capital that was returned to the investors plus their profits. And that's pretty much represents a good, almost about half of all the projects that we've done. And the upper portion, in other words, above the lines, of projects that are ongoing in various stages. Some of them are very soon to be completed. Some we just started. And so every quarter we look at our projects and we sort of like do a mark to market valuation to know where things are standing. I'll skip that part very quickly because it really talks about the various stacks of where we are. We do a lot of joint venture equity projects. We do preferred equity, mezzanine, and senior loans. And each and every one of them, if you can look at the upper portion, essentially correlates to how many dollars, how many projects, and what sort of returns we're able to create on an average. So if on a joint venture, our average return is around 26.9. And if you look at senior positions, first position mortgages, we're averaging around 15.8. And then you have some in between. We'll skip that part because, as
Hey
I
Joe,
said,
I just wanted to ask you. Why do you think your JV equity positions are performing, you know, at the top of the group?
I'm sorry, say it again, the question?
Your JV equity returns are quite good there. Is there
Yeah.
something in particular about JVs that make them particularly attractive?
Yeah, well, you know, it's joint venture projects as opposed to, let's say, preferred equity, mezzanine, or senior positions represents a different type of risk associated with that position, investment position, than, for example, a senior first position, right? If I'm in a capital stack and I'm the lender, then my position is obviously much lower in risk than the position of equity, right? Now, in between being a first position or a lender position, right? And in between that and that of equity, there's other positions. And so really, if you ask me, Joe, what do you do for a living? I'll tell you, well, I manage risk. Just so happen the risk that I manage is in real estate. I created a 30-year career, and now and I'm a professional when it comes down to real estate investments. And so in every project that we see, and we see around 700 projects a year, or if I'll say it differently, we are being asked to participate 700 times a year in various projects across the United States. And 98 times of those requests, 98% of those requests, not 98 times, 98% of those requests we say no to for a variety of reasons. The risk is not correlated either with the return, with the geographical location, with the experience level of those who are showing us the projects, or with the underwriting of those who are showing us the projects. And sometimes, unfortunately, the character is not a fit, right? All those things are extremely important. So 98% of all the projects that we see, we say no to for a variety of reasons. 5 of them I just mentioned. And essentially, each and every one of those projects that we say yes to represents a very different part of risk. There's some areas that I feel very comfortable to make 18% return, 19% return. We're doing a project now. Our investors are netting after our fees and everything else, are netting an 18% preferred equity position for paid quarterly. This is probably our best project. It is a representative of this time, right, where the market is down. So I'm very happy to offer my investors those type of positions and not increase the level of risk. In other projects, we're very happy to take those high returns because we can handle the risk very easily. With the majority stake, we know our developing partner very well. We know his capacities. We might have done multiple projects, but we
Sure.
ask for higher returns on those projects. So it's sort of like a balancing act, okay, between risk and rewards. I hope that
Do you
answers
have
that.
a set of JV partners that you tend to do deals with over and over and over, like a small
Yeah,
set of people that you tend to work with, or is
yeah,
it more
yeah.
wide open?
So, when we've started, we've done about 35 projects since inceptions. And as much as I feel that we pick locations and projects and project types and all the other teams that goes along with it, architects and engineers and GCs, so I feel we pick them very well. It's just how it is. There's some people are just better performers than others. It's just how it is, and it happens in any profession. And after doing it for so many years and having the lessons of so many projects, we sort of like created a much, much smaller, a much more concise list of participating partners, developing partners that we will follow and do deals with, not blindly, not every project. So keep in mind, our developing partners not always are aligned with our interest. Our interest is represent investors, right? We put our capital together, we club it together, and then we lead the group of where to put it and why we're putting it, and then what happens along the life cycle of the project, right? We go, we visit, we scrutinize the project, we approve on certain decisions, we always maintain control through a major decision. Not every project that I do is with the same developer, but yes, we did find that from the very many projects that we've had, some really stood out. The 80-20 rule. So from the
Mhm.
35, we really sort of like kept it into a 20% almost, around 5 or 7 today that we are super gung-ho and doing business with. And yet still within the top 20% that have been showing us returns, and we've turned project around and we've made tremendously good together for ourselves and our investors. Even with them, I'm still very picky and I don't go after each and every project. And there's a whole story behind that as well. But we sort of like, we're grinding it. We're grinding it. We started wide, we got narrower. And even within
I
this narrow group, we're now grinding it again to come up to that perfection. I want to say something. One of the track record that I'm super proud of is that we've never lost a dollar to investors, and we went through everything you can think of, right? From pandemic to inflation to supply chain to anything you can think of. Banks were pulling out and the market was going downwards and and anything insurance was spike. We don't have any losses, right? And our average, as you can see here, 23.6%, right? The one thing I ask my investors to do is that, let's create a path. If you're looking for income, if your path is income, then we need to focus on preferred equity and mezzanine and senior, right? They'll show less, right? But they'll create a stream of income, right? But I want to create diversification. I don't want to take an investor's capital and drop it into one pref equity deal or a senior loan or a mezzanine, right? I want to be able to create diversification. Diversification is another way, another layer that we can always maintain that our projects are doing well, and I think it's extremely important. Those that are less interested in income, they have different aspirations, they want to see the big returns, then they'll go for the joint ventures. And those are projects that you don't see anything along the way. There's no quarterly or annual distributions. However, you'll see your money back in about 3 years. It's going to come back in a lump sum check. Maybe it will be your money back plus 75%. Boom, right? One lump sum coming back. So everybody has different philosophy, and some individuals go with like, look, I'm going to spread out between equity, between pref, between mezzanine, between all sorts of positions. I think all of them are very smart, but as long as you create diversification, I
So
think
that's a really interesting distinction, and I'll let you go into the rest of your presentation in just a moment. But what you're saying here is that each of these different types of deals have different characteristics, and they're in different points in the capital stack, of course. With the JV
Right.
equities, you said there were no distributions. There's no cash flow along the way.
Yes.
You're looking at
That's
a partnership to. I assume these are construction projects.
Many of them are construction
Yeah.
projects. Yes.
Okay, and so you're investing the capital and you're getting a higher return on that capital because it's, or at least one reason is that it's all at the end.
That's right.
It comes back to you in a lump sum rather than
Very true.
being paid to you along the way. So
Very true.
that's an interesting investment dynamic that people should realize there, that if you pay distributions along the way, it can that money is being taken out of the deal and can't be rolled back into an eventual pay at the end. So there's different return profiles, I guess you would say, for each of these categories.
That's right. That's right. And different folks with different needs, different investment philosophies. We're doing a project now that we're taking not just we not just created a quarterly distributions, but we've also looked at creating a unique tax structure. And I'll go a couple of minutes into it. It's a project where we're building 50 apartments. It's a developer that we've been working with for the past 6 years plus. This is project number 7. Our investors are getting a personal guarantee by the developer, which is a very big to do because he's super high net worth individuals. We run an analysis on his financials. It's worth more than $350 million in assets. And so to get a personal guarantee and a principal amount, it's pretty unique. There's no upside, right? But the investors are going to be getting anywhere between 16 to 18%, again, distributed on a quarterly basis. So every quarter they'll get their proportionate share. What we've created is that in language, the returns are only a return of principal. And what we've done by that, instead of creating the distribution itself to be taxed as if it was ordinary income, which is obviously the highest of all the brackets, right? If you're making a lot of money, you could be finding yourself in a 45% bracket. So what we've created is, in fact, a return of principal. If it's a return of principal throughout the 3-year hold period of this particular investment, there's really no gains, right? It's just a return of principal. But the last year, the 3rd year, you're going to have whatever balance of principal left and the entire amount accrued. And so when you pay taxes on that profit, you're essentially paying long-term capital gains. So we don't just create hyper returns. We also find ways to protect our investors' capital in our own capital, of course, personal guarantees. Of course, we have ownership of the asset and all those different things, but we also create tax structures that will benefit our investors and ourselves. So a lot of thoughts goes into it. And I think this is one of our most popular, certainly one of our most popular projects. Yep. So those are some of the points. Any other questions, or should we continue? Okay. That really talks about the various locations where we've invested, how much we've invested in every area. I don't want to go too much. I don't want to make it sales pitchy, as I mentioned earlier. Um, let's talk a little bit about the current state of commercial real estate, right? Um,
Hey, hey, Joe, can you hear
Before
me
we
now?
make, yes, I hear you.
Okay, thank you. My microphone failed. I had to switch over. Go ahead.
I want to talk a little bit about the state of commercial real estate in general. As we said in the last conversations we've had, we've seen, if we look at the last 5 years, we've seen the market sort of like take a sharp down during the pandemic, then sort of like, start coming out of it, and then a very sharp up around 2021. Capital was so available. Banks were lending it like there's no tomorrow. Interest rates, you'd be borrowing capital at 2%, less than 2%. In one of our projects, we've had less than 2% interest, and it was just extremely available. That caused the market to sort of like propel up. Everything was going through the roof. It was a euphoric type of a period of time. That followed by March of 2022, where interest rates started climbing. We've stopped our operation, realizing that the Feds are out there to kind of like take a baseball bat to the economy in order to stop things, because inflation was sort of like ramping up in a very, very fast pace. And so every month the Fed started increasing interest rate, half a point, a quarter of a point, half a point, probably more aggressive interest rate increase within a span of about 40 years or so. And so we've stopped operation, because what's correlated, obviously, the cost of capital goes up, valuation goes down, and so we don't want to be continuing buying and investing into a market that is obviously in a decline. So we've taken a year plus, a year and I think a year and a quarter, a year or 2 quarters, sort of like a break, focusing mainly on our portfolio, asset management, and everything else that goes along with it, and then waited for the market to calibrate. Nobody really knows what the bottom is or where the bottom is, but sometime around a year ago, we felt that, with the interest rate still very, very high, inflation, which reached 9.6%, I believe it was in November of 2022, have declined to around 3.5%. The market was barely moving. There was no transactions. There was a lot of fear and a lot of distress. And this is kind of like the market that we produce our best work. We know how to raise capital. We know how to deploy capital. And so there's not enough out there. We've done some pretty substantial deals, and we were able to negotiate terms that normally in an up market we wouldn't be able to get. And so we slowly started picking up really the jewels where we felt super good and very comfortable. Well, where are we now, essentially? For the last, quarter, a couple of quarters, we're saying we're pretty much at the bottom, right? We're pretty much at the bottom. And the bottom sort of like tend to skate for about a year or so before we start seeing the first signs of the bottom starting to peak, right? Starting to come up, kind of like if you imagine a U shape, right? So 2023, I'm sorry, March of 2022, we've seen a decline, probably about a year into it, and then we saw this long, drawn out type of like a line, straight line representing where the bottom of the market is, maybe with a soft decline, and then slowly we're starting to see things come up.
I know
What
that
does it mean?
a lot of investors for a number of years now have had the slogan of survive until 25. Is that still your thesis for the macro on the market?
Yeah, absolutely. Absolutely. I think that we are at the bottom and we're coming up. I want to address something that Jelen asked. How are we reporting when we issue K1s to our investors? And in the K1, we're essentially saying return of in that particular deal, if you're asking. In the K1, we're simply showing the capital return as a return of principal. So in other words, you've invested $100,000, and the K1, maybe on that year, we've returned for you $16,000. Then the K1 represents a return of $16,000 in this particular example to principal. Since it's a return of your money, but not profit, and you don't have to pay taxes. Eventually, at the back end, you will pay your taxes. I hope that you understood my answer, Jelen. Um, and so yeah, we're looking at the fundamentals now. It's sort of like becoming more and more obvious for everyone that the era of of inflation is now sort of like at its last stretch. Last month, the Feds have announced a 2.9% inflation, and we're seeing, even if I drive by, look at the pump every day, even the pumps, we've seen an extra 15% drop, and everything else that's going on around us is sort of like showing us that, things are, the fundamentals in the economy are not as solid. Employment is down, significantly down than what they've expected. The Feds have expected 350, 370,000 jobs increases. The numbers were much more anemic. I think it was around 171,000 jobs. And so we're seeing the fundamentals starting to crack. The Fed is responsible and care for two things only. If you want to really simplify things, the Feds only care about two things: employment and inflation. Employment and inflation. They need to keep inflation low. Their aspiration is to reach 2%. God bless us all if we should reach it. And they want to keep employment high, right? And they're starting to mess up on unemployment, which means that there's a nice softening of the economy. Before we found ourselves in a position of a drop of the economy, or if you might want to call it a recession, then the Fed needs to do something to balance that act. And the only thing that they can do is effectively play with interest rates, right? Cost of capital goes up, then businesses stop expanding, stop hiring, cost of capital goes down, businesses expand, and then they hire more individuals. I need to
I
gauge.
can read those off for you.
Mhm.
AP is asking, the current slide, is it about single family or multifamily? Is that right?
It's
So
it's about essentially, it's essentially a question of about, we always look at where we are in the market and what sort of decisions individuals have to make. Will they be renting? Will they be borrowing? Or will they be borrowing money in order to buy? So buy versus rent sort of like gives us a good indication of where the psyche of renters are. And this is obviously for multifamily, for single family homes. They're all very much correlated. And so one of the things we look at to understand where we want to be in terms of investment is essentially what's the conversation, buy versus rent, right? And we'll see some pretty striking impact in certain areas and so on. To answer Zanita question, wouldn't that cause a taxable impact? It will create a taxable impact. What it will create for you when we will pretty much pack all the returns in this particular deal, when we pack all the returns to the back end, I essentially create for you a long-term capital gains. And a long-term capital gains is a capital gains that is taxed at 20%. On the contrary, if I'll offer you income as simply straight out income and have you report that income as ordinary income, then you'll pay according to your taxable bracket. Most individuals that we work with, we only work with accredited investors. Their taxable bracket is 35% and higher. Some are at 40, some are even higher than that at 45%. So yes, my interest is to generate high returns to my investors and to create the best possible tax structure that I can. In this case, my investors are making 16 or 18%, depends on how much they've invested with us. And if it's 60%, the taxable impact, based on long-term capital gains, will be 20%. Oh, smart. Okay, thank you. Thanks, Anita. We deal with a lot of smart people. We deal with tax attorneys and create the tax structures for that. And so, so to bring you sort of like, behind the kimono, as we say sometimes, and to get you an idea of where we want to be, should we be investing in condo projects? Should we be investing in rental projects? And why? We look at the decisions consumers are going to be making. And one of those decisions is the rent versus buy analogy, right? So look at all 50 states first, and then we factor in only areas that we want to pay a lot of attention to. And so we're still seeing that with cost of capital the way it is, right? It came down recently, right? But up until like a month ago, cost of capital was around, call it 6.75, right? If you have perfect credit and you're taking maybe a very low loan, maybe it's going to be lower than that. It was around 6.5. If you were to take a mortgage of 6.5 to buy an apartment of, call it 1,000 square feet in a place like Austin, Texas, right? The median cost of buying that apartment and paying a mortgage, let's call it 65, 75% of it will be mortgaged. The carry cost, okay, for that 1,000 two-bedroom square feet 1,000 square feet, two-bedroom apartment in Austin, Texas, at a median standpoint, versus a similar apartment that you could potentially rent versus buy question, what would cost you more? And unfortunately, we're seeing that in Austin, it will be about 144% more expensive to own the apartment, pay a mortgage, pay the taxes, pay all those different things, real estate tax, and pay the common charge and everything else, versus to rent the very same apartment. It's such a striking difference. We know, for example, that to invest in condominiums in a place like Austin probably makes very bad sense, right? So that's one example. We'll take a look at a few other examples, that we ran across certain areas. And as I said, take a look, for example, a medium-sized mortgage in Austin, 562, right? That monthly is 3,588 versus rent of 1,468. So I could be buying that apartment, house, more condo, whatever. It will cost me close to $3,600, or rent a similar product, and it will cost me $1,500. These are tremendous savings. But we see the phenomena happens all across places like Seattle, Columbus, Ohio, even Dallas, Texas, certainly near places like New York City and other locations as well. Why do we want to know this information? Because I want to know, where am I investing? I want to know what I'm going to be investing in and what sort of decisions consumers are going to be making. And that's part of how we do it, right? So now we're focusing on rentals, right? Because we know that cost of capital is expensive. We just proved to ourselves that it makes much more sense for people to rent versus to buy. Again, it doesn't mean that it will happen to you in 100% of the cases, of course, but it makes a lot more sense for a median household with median income to take an apartment and to rent it versus to take a medium-sized mortgage. And because of that, we're focused a little bit closer into what it is that we're doing in terms of rents. So where are rents hovering and what are they doing, right? Just we like Florida being a low no tax state, no city, no tax, no state taxes, a place that is getting a lot of interest from individuals from all across the United States, lots of immigration, lots of work, lots of opportunities, certainly inside of Florida. What is the area? Where in Florida do I want to invest, right? Florida, we tend not to paint everything with a broad brush, right? That's the first mistake. Oh, it's in Florida. It must be good. Unfortunately, no. Florida, like every real estate, it's a local conversation, right? It's a local conversation. Deltona is different than Orlando, and Orlando is different than Tampa. And so we have to look for markets that are not overly saturated with lots of product, areas where we see steady rent growth, areas where we see steady and solid employment. And so what represents to us good opportunities right now is the area around Miami. To account the appreciation of the house in the next 5 to 7 years and total loan amount. Okay. Somebody asked about, what about appreciation? Do you take appreciation into it? And obviously, our conversation at this stage was not looking into appreciation, but that's definitely, there's a lot to be said about appreciation. It's not just let's go a couple of pages back, maybe. Well, take a look at the most extensive one, Austin, right? So we have around $2,100 per month. Okay, I'm talking about the top line. The saving is over $2,100 per month. Cost saving is $2,100 per month. Now, what about appreciation, right? In real estate, we have this phenomena called appreciation, and depreciation, right? Are we talking about appreciation and depreciation? In Austin, on appreciation, well, are we essentially in an appreciating market, or are we in a declining market? Real estate definitely goes up in value, but we are short-term holders of assets, right? We buy assets for short-term hold. My objective is to work with investors where I can invest their capital alongside ours, where we can generate the highest possible return in a significantly short period of time, 2, 3 years, 4 years max. I want to be able to try and double your money if I can, or if not, and create a nice impact on return to you, right? So we're not long-term holders. Maybe in the future we'll find ourselves in a different system and we'll have long-term holders. They'll be designed differently, but we're not long-term holders. But in generally, obviously, real estate appreciates. And so that's obviously why people buy. They want to have pride in ownership. They want to buy an asset in a good location that over time it will go up in value, we hope, right? But that's not our game, right? So we don't buy long-term real estate. We don't hold it for 10 years and hopefully it will grow. We create value, we force value by building a building, right? Or by taking over an older asset and putting a lot of capital into it and force value in a short period of time, apex the value, and then exit it, and then being able to offer you those type of returns. Okay, so let's go back to that conversation. So obviously, picking the right location is extremely important to us. South Florida has been a very solid market. Even while most of the United States we're seeing small inclines in rents or even declines, Florida, I think Miami specifically is one of the strongest markets, and we're still seeing a very high growth. Something to be said about Miami. In the last 5 years, rents have practically doubled, right? Rents have practically doubled. I moved down here 5 years ago. I live in Bay Harbor Islands. My house at the time was renting for $5,500. I was renting for $5,500. And I was thinking to myself, it's a big house for me, for our family. It's a good size house. And the rent was just very reasonable, right? Today we're paying double. You might say, Joe, you're such a real estate guy and you're renting. Like, yes, all my money is invested into bricks. Everything that we have goes into all the projects that we do. And so go back to the rent versus buy. I don't want to go back and spend too much time on that, but I actually also do the rent versus buy. With me, it's a little bit different. If I will put $1 million and take a mortgage, what could the $1 million cut into those bricks be doing when I can make money at 25 and 26% a year? So that's why you can see my rent versus buy also has other things into account as well. So I'm not at my point in time, I'm not a big believer in buying, but that's for me, that's completely personal. I'm not trying to rattle anyone or trying to convince anyone otherwise. I'm talking about myself personally. And so we're looking at markets that have seen a double in the course of 4 to 5 years, right? Literally double. Those markets have created a very unique dynamic. A lot of folks who used to live here 5, 6, 7, 10 years ago can no longer afford those markets. And so what we're seeing a push outside of Miami, outside of the core city. It's gotten to be extremely expensive, but push up to where? We're going to talk about this in a moment. Okay, let's take a look at New York City as another example. It's another city that we track very much, a city that I built my career over for many, many years. We're seeing a crisis. The same crisis that we see in Miami, we're actually seeing the very same crisis in New York City. New York City now has a vacancy factor of 1.4%. 1.4%. New York City is occupied to the tune of 98.6%. So if you want to find yourself an apartment, good luck. It's very, very hard to do it. They have not seen this level of occupancy in 58 years. All right, it's a real crisis. So what does it mean? All the projects that we've built in New York, they've gotten extremely expensive. All the rental projects. We're up to the tune that I think our last project, we were renting a 550 square feet apartment in a neighborhood in Brooklyn, in Williamsburg. No doubt, cool neighborhood, no doubt a beautiful building. We're renting it for $6,700. That's $140 a square foot, if I'm not mistaken. It's an unheard of type of numbers. So it's extremely important to find an apartment. It's extremely expensive to pay in New York, and it's very hard to find an apartment. They do have a tremendous affordability crisis. So what do we do? Let's talk about inflation. We'll skip about inflation. I think we spoke about inflation enough. So what do we do? What do we do with all this data? To have all this information, right? What do you do with it? Where do you How do you monetize this information, right? And so if you look at the last two transactions that we've done, those transactions are in fact answers to the various situations and various fundamentals that are happening both in the economy across the United States and particularly in the markets that we choose to invest in right now. Let's take a look at the project on the left. On the left, we just finished a project where we've raised a preferred equity position for a project in Brooklyn, New York. Okay, it's an affordable project. There's about 80,000 people waiting for on a wait list, waiting for affordable apartments that are qualified for affordable apartments in New York City. We took a preferred equity position, and we're building over there 49 units. It's going to be sort of like a city program for families that have been phased out of their houses. They don't want to see them go through the system and jump from one shelter to the next. This is permanent housing. We're doing something amazing, something that I feel extremely well about, really good about. Families that are staying in a brand new house, in a brand new building. It's a blue collar neighborhood. It's not a sexy neighborhood where they're going into. And we're doing extremely well. And we've built ourselves into exactly what that city needs, okay, an affordable component. And the same thing is going on in Miami. In Miami, we're essentially seeing that our market is extremely hot, super expensive. Not everybody can afford it. A lot of folks are being phased out and are being pushed out. And so we went out and picked up with our partners 20 acres outside of Miami, 45-minute out in a place called Homestead. And then the idea over there is to build 354 apartments, and each one of those apartments are going to go on average to $2,400 a square foot, 800 square feet, $2,400 a square foot. What does it really mean? $2,400, $2,400 a month. I'm sorry, $2,400 a month. $2,400 a month, you can pretty much rent yourself a nice sized closet in Miami. But here, you're getting yourself a gorgeous two-bedroom. And so we find where the issue is, where the stress is, and we look to find for cure for those positions, right? And that's where I think we're able to convey and able to combine, in fact, doing good for our clients and doing good for everything around us, right? It's kind of like a win-win. We help the individuals, the local individuals, by offering them quality product at affordable prices, and we're making handsome return to ourselves and to our investors. That's a little bit about us, Daniel.
Well, I
It's
had
sort
a
of like
couple of
how we do
questions.
things.
Oh,
Sure.
so you've mentioned Florida, you've mentioned New York. What are some of
Yeah.
the other areas? I think you said there were 10, I forget the exact number, but a couple of key
12
areas
cities.
that you invested in.
Yeah, 12
Oh,
cities.
there was the list. New
There
York,
we are.
Florida, Illinois, really? Wow.
Yeah, Illinois with a specific project, Texas, Arizona, Ohio, and New Jersey. So each and every one of those, and then within them, we have various cities. So overall, 7 states and 12 major cities, 12 major markets. So in New
Okay.
York, we do mainly two types of projects. We'll do either affordable rentals or some sort of an affordable component. Maybe it could be like a super expensive neighborhood. And 30% of the units that we'll build in a building will be affordable, right? We'll get a nice tax abatement. We'll be able to offer some affordability in a gorgeous building. Other projects that we'll do there will be condo style projects. I can go through some of the pictures a little bit later. But these are the two type of projects that we do in New York. In New York, the projects that we do, as I mentioned, we go in, we go out. I don't want to stay in New York too long. I know New York too well. There's all sorts of political risk that we just don't want to take any part of. So we'll team up with a great developer. We'll be the equity. They'll bring some equity. We'll be the investors. We'll represent all the investors. Remember, our job is the collective bargaining, right? The collective
Yep.
bargaining. My thesis is if you're a real estate investor, but you really are a doctor on your 9 to 5, then team up and collectively bargain your way through. Have somebody who's experienced to represent you. And this is what we do. We represent investors and become that big block of capital that determines how things should go during the development. In Florida, for example, we have different projects. Some of them are fully sold condominiums. Others are rentals. In Chicago, Illinois, we've had one project which we've exited very nicely, and I wouldn't go back because the tech situation is complex. It's very hard for us to understand, and the market is volatile. It's hard for me to kind of like say I'm with two. Yeah, it's a little bit too choppy for us. And so we've made a beautiful project. We've exited well, but it's gonna be a while before we'll come back with Illinois. Texas, I think it's a fantastic market, specifically if you're in Dallas. And right now, I'm going to go back into or enter, in fact, into Austin. So Dallas is a solid market, a market that draws a lot of capital. It's a mature market. It's a lot of diversification, has a lot of industries. The employment in Texas, in Dallas particularly, is about 300, I'm sorry, $350,000, 350,000 individuals a year. It's a tremendously strong market. We've always looked at Austin. Austin has always been extremely expensive, and we never could take a piece of the action in Austin. However, Austin has came down severely. One of the top markets in the United States came down severely. A lot of capital left. It's exactly the kind of areas that I want to do my best work in those markets. And so we're looking very carefully into coming back into Austin. Um, Arizona, Phoenix, particularly a second market. We have a beautiful hotel over there that we finished building. However, it's overly saturated by a lot of apartments and a lot of units that came online. There's been an increase of about 80% in inventory within a span of 5 years. Watch out for stuff like that. And so I knew I wanted to be in Phoenix and in Scottsdale, but I didn't want to be in multifamily or residential or any form of residential because of the big spike that we were saw coming. However, because it's been dropping significantly, we're going to start looking into those market again. In Columbus, Ohio, we entered with a cold storage, which is a large industrial building, cold storage building. We're doing really well. And in New Jersey, we have a couple of deals that are essentially also multifamily in nature.
Okay. Are there any sectors that you really recommend that people stay away from right now?
Um,
I mean, you
yes,
can find a deal in any
yes.
sector. Office space might be an obvious answer to that question, but what's your answer?
My thought about office and my thought about retail, and I hope I'm not going to rattle anybody here, are as follow. I always shied away from office for the very simple reason that if I own a 100,000 square feet office building, and let's assume I have New York Mutual Trust representing 60%, one tenant representing 60,000 square feet, and the other 40,000 square feet is maybe a cluster of other tenants. If something should happen to my 60,000 square feet tenant, and that tenant goes dark on me and leaves, goes out of business, something, right? But I can't pay my mortgage. And it feels to me very much a binary investment. And I don't do binary investments. I don't do an investment where if we win, we win. And if the tenant leaves, then we all lose money and I can't pay the bank. For me, real estate is not a casino. And so I never wanted to go into any form of office. And we really were saved. Our portfolio, as I mentioned, 4.1 million square feet. None of it is office. If I look at office, it's office as part of a much larger structure, right? I
Mhm.
don't, for the very same reasons, I don't particularly like retail. I like it as part of a larger structure. When I look at a shopping center and my anchor could make or break my investment, I also see it as too binary, too speculative. I don't know, even if it's a grocery anchor tenant, which are much better than, let's say, having a Lowe's in there or something like that. I still don't know what would happen. It's just so many moving parts. And so I never go into those type of investments. It doesn't mean that people have done really well. I think the people should still stay away from office. But still, we don't know where the bottom is at office. Um, and it's very hard to even understand what the value is in office. Um, I know that, retail is stabilized. It had some good 10 very, very hard years, maybe even 15 very hard years. Um, I think that those two areas you want to stay away from. But I'll tell you what you want to stay away from, period. Stay away from people who are inexperienced, doing something for the first time in a new location. What do I mean by that? Um, I'll talk about this in a moment, William. But what do I talk about this? I mentioned before that we are being invited around 700, sometimes 800 times a year to participate in projects. We're an investment company. Investors come in with us because they say, "Hey, Joe, listen, you're doing this for 30 years. You have an amazing team. You have a great track record. I'll put my money with you. And I know that the returns are going to be just as good as if I would put my money with some developer who's nobody's going to be watching the way they're going to be transacting, right? Just think about it this way. When I show up to a development, I come in with $6-7 million, right? When you, the investor, show up to a development and you want to invest, maybe you show up with 100,000, maybe 500,000, maybe 200,000. You're not going to negotiate and have the same terms that we're going to have. You're not going to have a professional partner next to you that's going to watch how things are moving. You're not going to have a group next to you that's going to send you their reports and verify that things are according to plan and according to budget. That's what I call the collective bargaining. We collectively can bargain stronger and better with a $5 million check than you could ever do with a $100,000 check. And you'll have us next to you. And while we'll take a piece of your profits, after we take a piece of your profits, the returns are still going to be similar to how you would do it on your own because your splits are going to be worse than the splits that I'll get, right? So for me, it makes sense.
Just to let you know, we've got 3 minutes left.
3 minutes.
Yep. Feel free to
What
put
is
your
good
contact information up there.
My contact information, by all means.
But Anita, sorry, did you addressed William's question about which state is the best?
Laura, can you just put the information up there? Can you do that?
Yes, of course. So I'm going to take your remote control and I'm also going to drop Joe's information in the chat. Give me one
There
second.
you go.
Sounds good.
Yeah, I think we can say that.
Let me take control.
Okay. Let me very, very, very quickly go through this. Based on your business model, which state have you seen the best opportunities? I think the states with the best opportunities right now, if you can stomach it and you know what you're doing, are in fact Dallas and Arizona. I'm sorry, Texas and Arizona. Look particularly into Austin. Look particularly into Phoenix and the immediate area, such as Mesa and such as Scottsdale, into the sectors of of the multifamily.
I want to ask you about Mesa, Arizona there. Why you single that one out? We actually have quite a few people that live in that area in this group.
Oversupply, a tremendous oversupply, which essentially caused rents to drop by about just shy of 15%. 15% drop in rents is quite severe. It's quite severe. So around 15% drop in rents, well oversupply, very hard for individuals to refinance existing properties. We like the multifamily there because I think this is a whole new bottom that we're seeing. Same story goes into Austin. Austin essentially tremendous oversupply. Rents have dropped by about 16.9%. And so over there, we're also seeing a new bottom, a new low, and it will be just a period of time, specifically in Austin, before it's going to become a super expensive city again, one of the most expensive and very difficult city to enter again. I love Florida, of course, South Florida particularly. Let me touch on some of the questions here. What is your typical investment? What is your typical investment? My typical investment means we'll come in with around $4 to $7 million. My typical investment will be to partner with a super seasoned developer, best-in-class developer with many years of experience, 30 years, 40 years. We'll have the control rights. Collectively, we'll come in. We'll either have a cash flowing position through preferred, or we'll be shoulder to shoulder partners in the deal and make returns that are greater than 25% a year. That is our typical investments. What has been my poorest performance? Sorry.
Okay. Last question, okay?
Sure.
No, you can answer that one if you want, or you could say something.
My poorest performance is possibly a deal that would have been otherwise a very simple deal in Dallas, Texas. We entered with a fella that had 17 transactions done in this market, value add, 1970s type of a product. We bought 205 units. But in 4 months, I realized that my partner, my local partner, is not doing a good job. We gave him a couple of months extension, and then we had to step in. We removed that partner, and then we started running the property ourselves, just stabilizing it. And at the time we entered the market, the interest rate was 3.6%. Our loan was 3.6%. It was in, I think, February of 2022, a month before the Fed started increasing interest rate. And we found ourselves in a very different environment. And so what I've been doing for the last year and a half is holding the property. We put everything back together, increased occupancy. I suspect the returns are going to be single digit. I can tell you that all around us, there's default across the street. There's default 2-3 blocks down over. People are not able to sustain it. It's impossible. The mortgage have killed so many individuals, but we have the belief that maintaining your capital and our capital is of the highest importance. And so we'll do whatever we can to hold the property, even if there's no returns, and even if the returns are very low, we're okay with it. But preservation of capital is extremely important to us. So that's my lowest performers. It causes me a lot of hours of work. And it is what it is, but we're holding strong.
Joe, that was a really interesting talk, going through your experience as a developer in multiple different markets and what your reflections are on the current state of the market. Could we have everybody take themselves off mute and thank Joe for coming in and speaking to us today?
Thank you, Joe. That was amazing.
Thank you, Joe.
Joe.
Thank you, Joe.
That was a lot of information.
Thank you, Joe.
Thank you.
Thank you.
Thank you so
Thank you.
much. That is so nice of you to do it, Dan. It's very inspiring. Thank you very much, everyone. I had the pleasure of meeting Daniel maybe a year plus ago. We had a great conversation. We had another great conversation. He invited me eventually to come in and have a little bit of a chat and meet all of you. And this is the second time we're doing it. I really enjoy what you're all doing, and I wish you all the best of luck and best of success. And by all means, when we'll do a pitch, I'll ask Daniel to have a permission to do a pitch collectively to your group so that everybody can potentially benefit from it. But thank you all for having me here. It's very inspiring. Have a fantastic weekend. Take care.
Thank you. Thank you, everyone. Have a fantastic weekend. Next week, we'll be hearing from MAG CP Partners on their industrial portfolio. We'll see you all then.
All right.
Thanks all.
Daniel.